Good morning, folks, and welcome back to Almus Market Mornings. We end the week with a similar kind of sentiment as last Friday. The expectations of a rate hike by the Fed in September is below 40%, post a softer PPI. Now, one question is what components of the wholesale inflation was lower? Because if it's the high volatile items, then it might not take some time to change. Secondly, equities are also ending the week with a positive bias after a good move in US stocks. S&P 500 made an all-time high again. Nasdaq was up 1%. It has recovered well from the lows seen at the end of July, and yields were broadly lower. One interesting thing, even though the secondary market trading were supportive of the yields, the primary market auctions in which the Treasury issued about $25 billion of 30-year paper that had a yield of 5.21%, which is the highest since 2021. Good morning, JK. A couple of questions for you. What is the breakdown of PPI and what happened in this 30-year auction? Is it something of significance?
Good morning, Swaraj. Yeah, I think clearly the yields which have risen in the recent past definitely retreated after CPI and PPI numbers, but they still remain quite elevated. And from the reaction, or rather the response to the auction of both 10-year the day before and 30-year yesterday has been quite weak. The highest yield since 2001 for the 30-year and also for 10-year at 4.683, the highest 10-year yield since 2007. So when I say the highest yield, it is the rate at which the Fed has, rather the Treasury has issued the bonds. Of course, market yields have traded even higher also. So the yield staying higher is clearly an indication, not the inflation, it is a fiscal issue that the uh, you know US government is facing. We already told yesterday how the July fiscal deficit was at 423 billion, the highest ever for a month, and that's putting the full year deficit at more than 2 trillion. So markets confidence in the yields staying lower is much less now. And also there is no credible plan of how the fiscal deficit will be reduced or even the debt will be brought down. So I think this is a slow up move that will be still seen. Maybe at some point of time, we may even see a greater momentum on the upside. And also, don't forget that Japan, which is almost in the similar position as the US in terms of debt to GDP as well as fiscal deficit, is also adding to the bond market problems because their yields are still trading at the highest level. Whereas at least in US, there is a discussion about a rate hike, but in Japan, the rate hikes are very, politically driven. And so, despite the real yields being deeply in the negative, they are not raising the rates, though they continue to intervene in the forex without much success. So I think yields have many reasons to be on the upside. The auction is only an indication that the investors are demanding higher yields for holding long-term bonds in the US. Yes, yesterday PPI inflation came lower than expected. The goods inflation definitely came down, and particularly driven by the oil price retreating, whereas the services inflation was up. On the whole, it was at flat versus 0.2% expected. And for year on year, it was at 4.7 versus 4.9 expected. On the core side, it was, month on month was again lower than expectation, whereas year on year was bang on expectations. Now, why the PPI is important is because the final PPI number also feeds into the PCI inflation measure, which the Fed also, considers in their monetary policy decision. From that perspective, PPI is important, although they won't go just by the PPI, but eventually the PCE number, which will come later in the month, will have some positive influence from these numbers. But once again, as I said, the yields did retreat, but some of them recovered, and again, not really in a downtrend. Now, if you look at the market reaction, in other markets, stocks, as you said, all the three indices in the US rose, and S&P 500 made an all-time high. While we have been talking about various valuation concerns and concentration of the index in much fewer stocks, and not a broad-based rally and some sort of a equivalent of dot-com bubble, etc. For quite some time now, if you look at the prices and the charts, there is no indication or a signal that the market is getting sold. Therefore, the dips are really being shallow. Market continues to buy the dips in the market, although the participation might be lesser, but prices are not retreating meaningfully in a broad-based manner. So I think this is driven by still quite a bit of liquidity available in the market. It is only when the liquidity is threatened that we see the equities being somewhat rather helped down. So that is the situation, and that is also keeping the overall markets globally also somewhat supported. In Japan and South Korea again went up yesterday. If you look at the dollar, that's little change, and it, except for dollar yen, which keeps moving much more than other, major pairs. Now, the movement or the lack of movement in the currency market actually giving me a sense of, as if we are in December, the Christmas period. So this is also an indication the market is not having any particular direction or directional sense. The triggers, we have discounted a lot regarding the war and then the inflation, yields, etc. And the markets are currently lacking fresh impetus for moving the stock, dollar either way in a significant way. Yes, we did not have a forward guidance from Kevin War, nor has he let out any significant indication as to what Fed action is likely to be in the coming days, but we have had enough statements from other Fed members. Yesterday also we had quite a few members speaking about it. Mr. Birkin said it's still an open question whether Fed needs to raise rates to restore 2% inflation, or whether it is already on the way down. Mr. Hammock made an important statement that businesses have adapted to higher tariffs and oil shocks, and there is resilience in investment, but we do need policy rate hike to bring down the inflation. And while two inflation numbers are welcome news, no confidence that we'll continue to see that progress. Mr. Goldsby made a neutral statement. If the inflation drivers are from tariffs, then oil, then things seem to be on-time increases, and there is no immediate hurry to hike the rate as well. So this is the only feedback that the market has to act upon in the absence of forward guidance from the Fed. On the Middle East side, only one headline caught my eye. That is Treasury Secretary Bessent saying on Thursday that US is going to apply measures on Iran that have never been seen, but we do not know what they are, whether they are going to be new economic measures or whether the action on the ground. That is something that we should be kept guessing. On the Indian side, important data was on the trade. Trade data for July again increased. This was a high at 31.98 billion, was the highest since January. The increase from previous month was not significantly, very significant. But what I do see is that while exports increased higher in terms of percentage, in absolute terms, imports rose more than exports. That led to the goods deficit being higher. Overall deficit was at 15 billion. When I say overall deficit, it was net of commodities and services. It was still higher at 15 billion. So 2 consecutive months of 15 billion deficit is not good news, because now we are already in a situation where capital flows are missing, which normally funds the trade deficit and the current account deficit. Yes, the only source of funding right now has been the private flows or the remittances, which have been still on the higher side. But absence of capital flows and trade deficit rising consistently is a source of vulnerability or a source of challenge for the rupee, definitely. So this trade numbers need to be watched in the coming months. If they remain at these levels without capital flows being improving, leave aside the FCNRP, which is still a liability that the central bank will carry on its books on the forward maturities. So we still have a challenge, and that can become a source of vulnerability for the rupee. Short term, of course, the rupee has been in a very tight range, but significantly, while it is a slow market and a very narrow range market, we are seeing baby steps on the upside. On the USD INR, yesterday we traded at 95.43 as well. So the weakness is slowly seeping in, because the bids are very strong at the lower level. Hopefully, it does hold below 95.50 for this week, and next week, of course, we will see how the developments regarding Iran and US progress, which is main attention for the market. Thank you.
Thank you, Jakan. Yeah. Next week we do have that geopolitical event to look forward to if there is any sort of development on that front. Meanwhile, domestically, for India, the trade deficit number, which showed an increase from the previous month, the overall deficit, the merchandise deficit was at 31.98 billion. While the net of services, it was at 15 billion deficit. Overall, this 15 billion plus numbers for 2 consecutive months, it's not inspiring a bit of confidence. And USD INR, it takes baby steps on the higher side, also because broadly the currency markets globally have been quite. So even with respect to USD INR, the moves have been very limited. But yes, we do see it inching up slowly. Otherwise, market reaction, as we discussed, stocks of all three indices in US, they have risen. S&P 500 is at all-time high. Dollar index, it remains flat. Um, we discussed on the PPI, which was lower than expected. It was a mixed bag. Goods was lower due to oil prices, but services was higher. Overall, it was a flat number. We saw the auction results for the 10-year and 30-year, which the Treasury tried to raise, and it seemed weak, keeping the rate at which Treasury raises money at decade highs. So these are a couple of things, and this theme will carry forward in the next week as well. We'll catch up next week with a fresh round of updates. Thanks for listening. Have a great weekend.